Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Middle of the week, Wednesday morning. We are coming to you as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surbi and Mangalam joins us on the program today. Guys, good morning.
Hi, good morning. Middle of the week and muddling along. That's what our markets have been doing. Actually, not just our markets.
You said middling along.
Muddling along. But the fact is that with so many tariff headlines coming through, markets are behaving as if nothing's really happening. I mean, no matter how high those numbers are, some are as high as 40%. Markets are just doing their own thing as if it's just another day in paradise.
But that's exactly what it is, right? Just another day, because that's what Donald Trump's commentary is all about. He could say 40%, 50%. You remember the times when US and China were embroiled in this 118, 140, those absurd numbers. And everyone's now coming to terms with the fact that these are just conversation starters more than anything else. The good part is that yesterday, the last hour, the recovery that we saw on the Nifty, that up move that we saw, so to say, at least brought some excitement to an otherwise very, very feeble sort of market.
You know, normal people, when conversations are, normal people say, well, you know, let's catch up for a coffee. President Trump says, well, let's start with 100%.
140%. I think that's a good conversation starter. That's what I'll do to my friends. I'll just randomly message them, hey, you owe me 10,000 rupees. And then that person will at least reply.
All right. Well, let's just take it from the top because there is, there is a lot. Not very much in terms of the market. So the market was absolutely quiet. You know, the noise to signal ratio, if you can put it, I think it's got to be at a bit of a peak right now, right? I mean, so much noise, but how much of a actual signal, real takeaway from a lot of what we're hearing from President Trump, etc., is there? I think that is entirely very much debatable, and that is, I think, a crucial point. Ignore the noise and look for the signal out of all of what is coming through. So global markets were very, very quiet. S&P ended about 0.07% lower. Trump essentially said, he said a lot, but he basically said that there would be no more extensions past the 1st August deadline. But, you know, we'll see. He's essentially, of course, also said yesterday, we played those sound bites out that, well, we've made final offers and the 1st of August is the new deadline. I mean, the tariff rates, of course, broadly are similar to what we saw announced on the so-called Liberation Day. Now, Trump called for a 50% tariff on copper imports, 50% on a commodity which is used every day in pretty much everything. But you know, it's that's what it is. The point, though, is the timelines for this are uncertain. I mean, will this be done, by in the next couple of months? Will it be postponed after that, etc.? But of course, I mean, prices. Copper futures were up 17% at one point. Intraday, it's the largest gain intraday since 1988. But then, of course, they cooled off. Lastly, I think because of this uncertainty around implementation timelines, they were up about 10%, still very, very large as far as copper is concerned. And the other thing, which I think audiences here in India would also be interested in, is pharma. So he said that he would offer pharma companies at least a year grace period, that is 12 months, at least 12 months, before applying a crippling 200% tariff on foreign-made pharma products. 200%. But the thing is this, right? Trump was elected when? In 2024, late 2024. We're in 2025. If these, tariffs are, according to President Trump, going to come into effect at least 12 months out, we are talking about 2026. I mean, sometime in the middle of 2026, maybe a little later, in terms of implementation. Now, you know, it's a 4-year term for President Trump. He cannot run for another term in that sense. So actually, you know, in a counterintuitive way, it looks very, very bad. But obviously, we will not see, new investments, etc., in the US because of the uncertainty around the tariffs, etc. But the point is, in a counterintuitive way, does this actually remove some of the overhang for Indian pharma companies as well? Because he said, 24 is gone, 25, 26, and then maybe, 1.5 odd years. And of course, that also is not very clear. I think he said 12 to 18 months, but at least 12 months. So I think keep an eye out on some of these names. But there is, of course, no rush. It's not as if there is any big trigger, a tailwind apart from this for pharma companies, and this was kind of capping gains. So remember that. But in a broader sense, the way I would put it is, stocks should not fall. I think if anything, you should look at it from the other side. Now, Trump, of course, also repeated his BRICS warning, which is the grouping of countries. He said that traditional 10% tariffs for just being in BRICS. This is something he said talked about earlier as well. He also spoke about EU, China, sectoral tariffs. A lot of this was sort of said earlier, so I'm not going to go into details and repeat many of this. Now, markets globally in a bit of a wait-and-watch mode. Indices have done extremely well. US markets, for example, remain less than 1% away from all-time highs. So it's not as if they've been damaged at all. If anything, the other way. Oil prices $70. So there are reports that Yemeni Houthi rebels are attacking commercial ships. This was a Bloomberg headline. There's also reports that President Trump and Netanyahu, the Israeli Prime Minister, are meeting privately. The agenda is unknown. So again, to keep the Middle East, I think, at the back of your mind, it's kind of sort of faded into the background after the ceasefire between Israel and Iran. But oil, I think, is the one thing you will see as an expression if the markets start to get worried again. Just to tie in the levels, they're not changing very much at all. Yesterday, in the last hour, we saw a sharp spike higher for the Nifty Bank, but it was a sensex expiry yesterday. So I think you will see some action at least. Nothing like what we used to see earlier. So the support 25,331 on the downside. The resistance comes in at 25,669. For the Nifty Bank, the support comes in at 56,838 and resistance comes in at 57,628. GIFT Nifty will give you a quick sense of how we are likely to start. It's neither here nor there kind of start, about 24, 25 odd points lower. Surabhi.
Yeah, I guess, Prashant, we'll only know in hindsight, right, whether the market got this one right as well, like it did COVID, because the market kept rallying through after the initial dip. The only time the market got it wrong was the global financial crisis, because the market couldn't guess that the financial market itself was broken. But otherwise, the markets have usually called things right. So let's see. Maybe that happens once again, because if you go by market reaction, there's nothing dramatic. President Trump is talking about all these tariffs on countries ranging from 25% to 40%, 50% on copper. Look at the market reaction. It could be just another day, as we are saying. That's what's playing out. In the Hong Kong market, there's some more pressure. That market's down 1%. We've got data out of China this morning. Deflation in China is still a problem, especially at the wholesale level, because look at the producer price numbers that have come out today. The decline is 3.6%. The expectations were for a 3.2% fall. And this is continuing. This is the biggest decline in producer level inflation that we've seen in 2 years in China. There's some better news on the consumer side, because consumer inflation has picked up after 4 straight months of decline. The CPI number is up 0.1% for the month of June. So that's China data. Now, coming to the copper levies, 50% levy on copper. Just some stats to keep things in perspective here. The US imports 50% of its copper requirement. Bulk of those imports obviously are coming in from Chile. They have the biggest mines, on planet Earth. And now with the 50% levy on copper, steel, aluminum, and copper, all the 3 key metals are at the same base in terms of tariffs, which is 50% plus. So we have to see how this is digested. The copper price itself was rallying 13-14% yesterday. Some of the copper miners which are listed in the US, like Freeport, that stock was up about 5% as well. So he spoke about this 50% tariff, and then there was this big scare of 200% tariff on pharma imports, maybe the next 1 year. Let's actually listen into that precise soundbite, and then we'll take it from there.
Ones we did steel, as you know, they're 50%. We did aluminum, 50%. Lumber just came out.
Why don't you announce copper?
And we did cars. And now, today we're doing copper.
Copper and lumber. What would that tariff be on? The sectional tariff?
I believe the tariff on copper, we're going to make it 50%.
50%.
And we'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%. We'll give them a certain period of time to get their act together. But they were all here, now they all left. They went to other places because we allowed, people that sat in this room allowed it to happen. And I don't allow it to happen. The people in this room don't allow it to happen.
I also went on to say that the people in that room and the ones who were running America were stupid people. It's classic Trump style. But anyway, now we'll talk more about this in just a bit. Let's talk about the flow situation as well, because the market's been absolutely comatose over the last couple of trading sessions, barring yesterday's last half-hour move. That could be in parts attributed to the fact that it was weekly sensex expiry. Look at the fund flows. FII is on the edge. I mean, basically sitting on the fence. 26 crores of net buying coming in. Domestic institutions bought stocks, cash stocks worth over 1,300 crore rupees. Today is a very important day. Again, we have the monthly MF flow data coming in. Remember, in the previous month, in May, the equity inflows had dwindled to under 19,000 crores. So keep that in mind. Let's see if there's a pickup or not. But the markets become so range-bound that maybe people are looking for other alternate avenues or not. So today's number becomes very important. It's been a continued declining, streak of flows falling in equity funds. So let's see if that changes or not. Stocks and sectors in focus. I'll keep textile and apparel on the radar still. Some of these stocks were up and about yesterday because we still don't know. The hope is that despite this, BRICS tariff that he's talking about, another brick in the wall, so to speak, 10% breaks. If we continue at 10%, then we'll still be maybe competitive with Vietnam, with Bangladesh. So let's see. The pharma index for sure, though he's talking a year out in the future in terms of this 200% tariff. But let's see if there's any volatility on pharma stocks. Tata Motors wholesale numbers are out and the sales are down 9%. And Union Bank of India, really weak performance for Union Bank. Advances are up less than 7%. Deposits are up just about 3.5%. So not too great. So let's see. We'll watch what's on these stocks. Mangalam?
Well, we've been talking about how the market is absolutely range-bound. So I was just looking at the Nifty high minus low over the last 1 month or so. And guess what? If you just look at the range that the Nifty has been trading in, day before yesterday was 82 points. Yesterday, despite the up move that we saw, all of 123 points. And for an index which is upwards of 25,000, 200 points is less than 1%. In fact, over the last 1 month or so, the average traded range on the Nifty has been 195 points, with the highest being 350 points, which is 1.4%. So that's the kind of market that we've been in. Nifty hovering between 25,350 to 25,650, give or take 20 odd points. Despite the up move that we saw in the last hour yesterday, the Nifty added all of 61 points. The good part, however, is that two large parts of the indices, both the Nifty Bank as well as the IT index, did well in yesterday's trading session. The IT index will be in focus ahead of IT sector results. And at the same time, this index is also fairly off its highs. The broader markets, they were under a wee bit of pressure in yesterday's trading session. Yes, there was a recovery in the last hour, but Nifty, Next 50, mid-cap index, small-cap index, all of them ended lower. If you look at, the overall futures position by the FIs as well, they sold about 268 crores. They've been managing their net exposure fairly well over the last 5 or 6 trading sessions. They added about 4,100 longs, added about 4,100 shorts and 2,800 longs. If you look at the FII exposure over the last 5 days, you'll be surprised because nothing has changed. 29, 29, 28%, 29%, even as their net exposure has moved more towards the short side. But because of the up move that we saw yesterday, a lot of the call writers got taken out. So 25,400 call saw 10 lakh shares being unwound. 25,450 call also saw about 10 lakh shares being unwound. So a large part of the up move that we saw yesterday, while it was sensex options expiry, we saw some of these nifty option writers also cover their positions. And as they did that, the put writers got into action. So 25,500 put writers and the 25,550 put writers increased their positions. And 25,700 call writers actually went ahead and did some punt buying. So if the market were to break out beyond the range of 25,650, then perhaps there could be an up move, is what these punt buyers are betting. The good part is that, the range seems to have moved higher from 25,350 to around 25,450 at the lower level. And resistance too has moved about 50 points higher to around 25,700. That's about the index. The stocks that I'll be watching out for today have to be the paint stocks, Asian Paints as well as Berger Paints. Why do I say that? Because on the day AkzoNobel and JSW deal was announced, paint stocks were buzzing. We had spoken about 4 or 5 reasons why. The demand sentiment is improving, raw material sentiment is more contained. The stocks have already seen a decline, and more importantly, people are now sizing up competition. Since then, there have been a couple of brokerage upgrades. ICICI Securities turned positive after 4 years, and today we have Goldman Sachs as well as Jefferies and HSBC, all of them turning positive on the paint space. So my sense is that if the consumer sentiment has to improve and staples are doing well, why not paints?
Okay, all right, Mangalam, got it. So paint stocks, some positive cues and voices finally coming through. Well, let's kick it off then with the equity call of the morning. And this one's coming in from Rupal Agarwal of Bernstein, who says earnings revisions was the best performing style of 2024. She means in terms of stock picking. They have been waiting for this style to become attractive again. She says earnings revision is the only factor to be reasonably valued on absolute basis and be one of the cheapest relative to the market. More importantly, the portfolio, she says, is showing signs of bottoming on earnings downgrades after reaching extreme levels on both absolute and relative basis.
All right, that's the view which is coming in, and we'll get you more as we go along. Arvind Sangur is managing partner at Geosphere Capital. He's with us now. Arvind, good morning. Great to have you with us here. Appreciate it. Just a quick word, Arvind, on pharma specifically. Would you agree? I don't know if you heard some of what we were saying earlier. I was saying 12 to 18 months out, these pharma tariffs on foreign-made pharma products. I mean, that is almost going to be in the second half or the last 1 year of Trump's term. So from a market standpoint, I mean, actually, it's not bad at all.
Well, I guess it is okay. It depends on the timing. It depends on the magnitude. And whether the next president will completely roll it back after Trump is gone. So, I suspect there might be a bit of a relief, but I think the overhang of the uncertainty is still there. So, I think some of the more extreme measures, as we've seen before, are unlikely to come to pass. So I think it's going to be a mixed bag. I'm certainly not rushing out to buy pharma names on this news, but some bottom fishing could happen, I suspect.
Arvind, hi, good morning. On India, now, there's just so much going on with trade, right? It seems there'll be a deal. He's called it out. But we don't have a sign of it just yet. There are sticky issues, and India is also taking the US to the WTO on several parameters. And then there's this pharma threat hanging. From the market standpoint, what should we read through and what should we take along? Because the market has gotten very quiet in the last few sessions.
Well, my sense is the market may be waiting for some trade news, but as we see the other markets, whether it was Japan or it was Korea or anybody else, the tariff news from a day ago didn't cause a huge, a disruption in those markets. So my sense is at this point, tariffs are kind of part of the fabric of the noise in the market, and they will affect some short-term moves. I think the problem, in my opinion, in the Indian market is all of our, indicators like four-wheeler sales, two-wheeler sales, CV sales, every high-frequency indicator is showing a really slow economic outlook. So the earnings that is upon us, I think the market is as much waiting with bated breath on what's coming from there as assuming it's all about tariffs. So I think there's a fundamental side of the India growth story, which has nothing to do with tariffs, which is also not firing on all cylinders. So that may be part of the reason why the market is having a hard time, getting any momentum going.
Well, that's interesting because a lot of the, people who watch the market are saying that maybe things are turning, and from here on, growth engines will begin to fire, especially on the consumption front. But, be that as it may, what would your strategy then be in terms of allocation to the Indian markets, if at all? What would be the places where you think would be, fairly safe to hide?
Well, that's an interesting question. I think, we've been using a much more bottom-up approach in financials. I think clearly, the RBI has been quite supportive and with everything they've done to ease liquidity. Clearly, the financials can be, interesting, and I think that's an area that we definitely like. Some special situations which have lagged and have valuation support. But other than that, I would say it's more selective rather than any big theme. We certainly, I will say this. We're staying away from IT because of the headwinds of, the technology risks from AI, although, stocks, again, the growth has not been anything to write home about. And valuations are not really compelling. But, there may be a trading play there. But, our preference is companies that benefit from what's going on in the gold market long-term That is a theme that we like. But we like companies that have more domestic consumption exposure, like you said. That's an area that we think is in better shape. Although, again, as I said, we've been a little disappointed by some of the higher value items like autos and CVs. But other parts of the consumption story may be a little better position.
Okay. So maybe discretionary consumption, that's the one thing that's worked in the Indian market for the past many quarters. Arvind, but overall, just to go back to just the way the US market has taken all of it in its stride as well, numbers are still good. I mean, the macro numbers are still good. So what, more upsides, at least for the US market, you think?
Well, I think the US market has been amazingly resilient, and the US economy has been amazingly resilient in the face of all the tariff news. There are some who believe that the lagged effect of some of these tariffs is going to start showing up in the next couple of months. But I think that this is a market which clearly seems to be more bullish oriented, and we are cautious, but not maybe we've been too cautious. And I think the market itself, till we see signs of economic damage or inflation rearing up, I think the U.S. market and the U.S. economy seems to be on surprising good footing. And frankly, the U.S. is in great shape from a technology standpoint, from an energy leadership standpoint. So those are all tailwinds for the economy. But the tariff noise at some point, it could create headwinds. But amazingly, from Liberation Day of early April, so far it has not shown up in the economic data.
Anant, we'll leave it there. Thank you very much for joining us. Great speaking with you. It's a pleasure having you here on CNBC TV18 and this program. What we'll do is we'll take a quick commercial break here. A list of top stocks to watch out for lined up on the other side. Stay tuned.
So it's the same headline that we've been repeating for the last 2-3, today's third trading session, that markets have been resilient. There are no major moves across Asia, barring the Hong Kong market, which also has now cut its losses from 1% to about 0.5%. So tariffs are not really shaking markets too much. Let's pull up the implied open. We've anyway had very quiet sessions so far in the week. Let's see, 26 to 27 points lower. That's how we may start. As usual, lots of stocks in focus. Q1 updates have been coming in. Let's look at the list for today then. And we have our team standing by with the CNBC TV18 list of top stocks to watch. Guys, good morning to all of you. Let's start with the updates coming in, production updates and monthly updates. Vivek, JSW Steel and Tata Steel, how do they look?
That's right. So metal companies have gone ahead and given their production as well as sales updates for Q1. These are the provisional numbers. Do note that. So first up, have a look at JSW Steel. Looks like a good set, especially as far as the crude steel production is concerned, up 14% on a year-on-year basis at 7.26 million tons. The Indian operations actually saw an uptick of close to 15%. Now, talking about Tata Steel, remember many moving parts over here. When you're talking about the domestic or India production volumes, that is actually flat on a year-on-year basis, impacted by a blast furnace shutdown as well as maintenance operations. The sales delivery volumes, however, was down close to 3.8%. Now, coming to the Netherlands portion of the business, production at 1.7 million tons versus around 1.63 million tons last quarter, and sales at 1.5 million tons versus 1.47 million tons. So again, expect a marginal red as far as Tata Steel is concerned today.
All right, we take that point. Vivek, thanks a lot for that. Gaurav's been giving us all the updates from the financial space, and today it's Union Bank. Doesn't look very good, Gaurav.
Well, yes, another weak quarter for Union Bank is what we can say, because this is the fourth quarter where we are seeing loan book growth at a single digit. Now, in this quarter, we are seeing the loan book growth just at around 6.8% on a year-on-year basis. Now, this is largely led by retail, agri and MSME segment, which also implies that the corporate growth was actually weak. When we look at the numbers, now it implies that the corporate growth was just at 3% on a year-on-year basis. And this also means that 4% to 5% decline on a sequential basis in terms of corporate growth. On the deposit fronts also, we did not see any many good numbers. This was actually 6th consecutive quarter where we saw weak set of numbers from Union Bank. In fact, there have been some reclassifications, and we will be watching out on how the commentary is going to be on that reclassification for deposits. But specifically in terms of advances, weak set of numbers. In fact, let's also not forget that in FY25 also, bank could not meet its guidance for advances and deposits. And for FY26, they have not given any guidance. But for now, weak set of numbers for Union Bank.
Okay, all right. Union Bank not looking that great either on advances or deposits. Thanks for that, Gaurav. Let's get to some more updates. Sonal, I think you're watching out for Signature Global.
Well, yes, I am. For Signature Global, while it was a YOY decline, which the company says is because of high base, quarter on quarter, the number looked really strong. The sales value was up 63%, area sold was up 19%, but these two parameters were down on a YOY basis. The collections were down both on a quarter on quarter and on a YOY basis for the company. Debt remained at 890 crore rupees, which is a flattish number on a quarter on quarter basis. Now, in terms of their FY26 guidance, it is at 12,500 crore rupees and collections at 6,000 crore rupees. And Nuvama says a rising collections trajectory and improving profitability would mean that the company would be seeing cash flows, free cash flows rising, and they could be debt-free by FY27 as well. So going with green for Signature Global.
All right, going with green for Signature Global. Thanks a lot for that, Sonal. Let's move on to an important corporate story which will have an impact on Sun TV. The family feud has ended. That's a Money Control exclusive. Chandra Shrikant of Money Control joins us now. Chandra, it was just a couple of weeks ago where the brothers were, up in arms in terms of courts and legal notices to each other. You think that it's been sorted now?
That's right. We had reported a few weeks ago that Dayanidhi Maran had sent a legal notice to his older brother Kalanidhi Maran, making a range of serious charges. But from what we understand from our sources, Tamil Nadu Chief Minister M.K. Stalin has played a pivotal role as mediator to bring about a truce between the warring brothers. So we're picking up from our sources that a meeting was held in the presence of Tamil Nadu Chief Minister M.K. Stalin, who, remember, is a cousin of the Maran brothers. So he met Kalanidhi Maran, Dayanidhi Maran, as well as their sister Anbu Karasi to hammer out a settlement and bring this issue to a close. It's not clear yet what the contours of this settlement are, if this will just involve a monetary settlement with Dayanidhi Maran, or if he will also get some businesses that Kalanidhi Maran currently operates. But this should come as relief that, they're not going to fight this out in courts because clearly the stakes are very high considering the elections in Tamil Nadu are also just a year away. So the Tamil Nadu Chief Minister being about a truce between the Maran brothers.
Okay, all right. So perhaps good news and some relief for Sun TV shareholders as well if this is settled amicably. Thanks for that, Chandra. Important story there. Let's move on. Vinny is tracking Lupin and CAMS. Vinny, morning. Tell us why.
Good morning. So Lupin, firstly, we're keeping an eye out on this one. They've signed an agreement with Zentiva KS Czech Republic for commercialization of Lupin's biosimilar. And this is a biosimilar called certolizumab, which is mainly used for treatment of several autoimmune as well as inflammatory conditions that are caused because of that as well. So now, obviously, they'll be covering a lot of international markets except for Australia, Japan, Brazil, Philippines and India. Now, Lupin will actually be responsible for developing and manufacturing and supplying these products, while Zentiva will handle the commercialization in Europe as well as CIS markets. Lupin will commercialize in US and Canada markets and other remaining regions which they've agreed upon. Now, Zentiva will actually be making a non-refundable payment of $50 million, which will include an upfront payment of $10 million as well. So we're expecting green here on the back of this agreement. Lastly, we have also CAMS that is in focus. Green expected here as well, as they've launched CAMS Pay that has been launched by the company. This is a new payment gateway and now gateway, I beg your pardon. And they will be supporting around 5,000 transactions per second. And this is going to be mainly to address challenges like there are transaction slowdowns or reconciliation in terms of issues that are going on, and that is what they want to address in terms for users coming in as well. So green expected here as well.
All right, new products for both these companies from different sectors, positive news coming in, but a lot of other stocks which are in focus this morning. Upasana joins in to give us that list. Upasana.
Good morning. First up, let me start with EPAC Durables. The company has commenced the commercial production of washing machine at its Sri City plant for the utilization of the enhanced capacity. Next up is Bajaj Projects on the back of capacity addition. Now, company has planned a capacity addition of nearly about 170 crores at Ranjangaon facility from Q4 FY26 to Q4 FY27 in a phased manner. Now, with this, the capacity addition of the company, the galvanized capacity of the company will increase from 40,500 MTPA to nearly about 1.1 lakh MTPA is what the company has indicated. And the key rationale behind this capacity expansion is to meet the captive demand, which is increasing, and the sales in domestic and international market is what the company has indicated. So hence, I expect both these stocks to open in green today.
Okay, all right, got it. Thank you for that, Upasana. Let's then wrap it up with the Sudarshan, who's watching out for Petronet LNG. Sudarshan, morning. So what is this, some relief on some regulatory issues with the board, PNGRB?
Good morning, Surabhi. So in January of this year, 2025, PNGRB had come out with a proposal saying that regasification activities of LNG companies, both Petronet LNG and GSPC, have to come under the purview of PNGRB to ensure fair pricing and efficient utilization of their LNG infrastructure. But these LNG companies were against that. Basically, they were saying that they are not required to come under the purview of PNGRB. But following that, these companies had moved to Delhi High Court. Now, Delhi High Court has given the interim relief to these companies, saying that no coercive action can be taken until the next hearing, and the next hearing is scheduled on October 9. And remember that the day PNGRB had come out with this proposal, we had seen a sharp drop in Petronet LNG stock. That day, stock had fallen more than 5%. So this interim relief can be taken positively by the street.
Okay, all right. That sounds really important. At least it's not a final relief, but as Sudarshan is explaining, at least some breather coming in from the courts for these regasification players. Thanks for that, Sud. Let's quickly recap our list of stocks to watch. Then the ones that have positive news flow are JSW Steel, Signature Global, Sun TV, Lupin, CAMS, EPAC Durable, Bazaar Projects, and Petronet LNG. Stocks with negative news flow would be Tata Steel and Union Bank. Okay, that's the stock list. But let's not forget, we have to watch out for all the oil and gas stocks as well, because crude oil prices have flared up. And Brent is at $70 a barrel. Manisha is joining in. Manisha, morning. We thought with the OPEC deciding they'll keep pumping more and more, prices should go down, but they're going up. What's happening?
Well, yes, so that has surprised almost everybody in the oil markets there. But with the kind of reaction that we're looking at in the crude oil prices, we've gained a percentage point yet again overnight. With that, we are trading at a 2-week high, and $70 a barrel is on your screens right now. Well, it is also about tightness in the middle distillates, the ongoing Houthi attacks on cargo ships on Red Sea, and the U.S. inventories have continued to decline. This week is showing a decline of 2.6 million barrels. This is a 6th weekly decline in 7 weeks. So while, yes, a longer-term projection is still of oversupply, pardon me, but for the very near term, the markets do believe that there is tightness, especially in the middle distillates. The Atlantic hurricane season is upon us, and the U.S. demand in sense of its driving season also could be supportive of prices. So $70 per barrel it is.
All right, $70 per barrel it is. Manisha, thank you so much for that. Higher from what we saw earlier, but still lower than what we've seen before that as well. Take a short break. On the other side, we'll get speaking about the consumer space. The management of Bazaar Style Retail joins in to discuss their FY26 outlook, their first quarter update, and what the consumer sentiment is like. Welcome back. You're watching us here on Bazaar Morning Call on CNBC-TV18, and the company on our show right now is Bazaar Style Retail. Their first quarter operational update was good. 37% revenue growth, 22 new stores added. Same-store sales growth were under pressure because of the shift of Eid in the previous quarter. Shreyans Surana, who's the MD of Bazaar Style Retail, joins in. Shreyans, before we speak about the numbers, etc., I have a grouse to make, not just with you, with all the other retail companies. In the first quarter update, they've given their normalized same-store sales growth had it not been for the shift in Eid. But what's interesting is that none of you guys in the fourth quarter gave us an adjusted same-store sales growth downward when Eid was in that quarter itself, right? So basically what has happened is that the fourth quarter same-store sales growth was upstated because of Eid, and y'all did not downstate it. And the first quarter, y'all give us an update, which was lower, but then y'all give us a normalized number as well. So when it suits you, you go ahead and give us a normalized number. But be that as it may, that's not just you, that's the entire sector. 37% growth in the first quarter. What's your target for the entire year, and how has sentiment picked up in the second quarter so far?
So basically, in the fourth quarter, the last year, the Eid was on 11th April, and last year it was on, this year it was on 31st March. As a result, when we were delivering the updates about the Q4, we were not able to clarify the amount which should be adjusted. But in the Q1, we have adjusted that 11 to 12 days of Eid sale, and we have given that normalized growth. We have grown at around 37% for this quarter, and if you see for the first half, we have grown at a rate of 45%, with an L12 growth of 8%. We have also given that number. In terms of this year guidance, we have guided for 25% revenue growth, and with an L12 growth of around 7 to 8%.
So, Shreyans, let's talk about the year as a whole, right? Because then there'll be Eid and then there'll be Diwali, and something will fall in Q1 and Q2, and then that's an ongoing debate. But for FY25, you did about 13% same-store sales growth, right?
Correct.
So let's talk about the full year. I mean, can you improve that performance? Can your SSG, grow to maybe 15% or something thereabouts? What's your full year expectation? Revenue, you've told us, but same-store sales?
It's around 7 to 8%.
Oh, that'll be 7 to 8%. Why are you working with a possible decline in same-store sales growth?
It's not a decline. Actually, for the last 3 years, we are growing at a rate of more than, last year it was 13%. Before that, it was around 10%. So we always take a conservative growth guidance for our mature stores, 7 to 8, with intent to grow higher on that term.
Got that. And what kind of store addition are you factoring in? Because, in the previous quarter, you added close to around 21 stores. You have a target of 40 to 50 stores. You've added stores at over 25% CAGR over the last 3 years. What's your target for this year?
Again, between 40 to 50 stores.
40 to 50 stores. And what about the availability of real estate? Because a lot of people are saying that while they're, looking to open stores, availability of locations is a bit of a concern. And that may also lead to increase in the rents that they have to pay. Will that be a problem for you?
So I don't think we are facing right now that is a problem, because most of our stores are opening in tier 2, tier 3, tier 4, where still there are only 2 to 3 organized retail players. And because of our approach of the cluster-based strategy, we are working state by state. We are not going pan-India. Wherever we are going, we are finding good locations over there.
Shreyans, let's also talk margins. For the full year, you were at around 13.5%. For this year, FY26, you've said that margins may improve to 15-16%. What's driving this? Give us some more color on the pulse of the consumer. Is the consumer up trading? I don't know if anyone's even thinking of price hikes at all. Or is it going to be a difference in the mix that will drive it? What makes you confident on margins?
So margin guidance is around 14 to 15% on EBITDA. Not 15 to 16, it's 14 to 15.
No, your target.
15%. You're targeted for FY26.
Yeah, for target for 26, EBITDA is 14 to 15%.
Oh, okay. 14 to 15%.
Because the last time you joined us, you did say that, it'll be 14 to 15% for FY25 and 15 to 16% for FY26. And that's what we remember.
So this year the guidance is around 14 to 15% only. The similar guidance last year. And in terms of pricing, we are not increasing anything. Our ASP is around 300 per article. The target is simple, that any customer walks in with 1,000 rupees note, we give him 3.5 articles and a style for a day. So it will be more volume and assortment is rather than price.
Very clear value proposition, right? Walk in with $1,000, get at least 3.5 articles. You're fully styled from head to toe. Pretty interesting. On volumes itself, then, Again, what would be the increase in volumes that you project, and is it going to be more back-ended when the full-blown festive season comes in, or what are you expecting in terms of H1, H2 trends?
So see, in terms of trends that we see, last year also in terms of growth, we have grown at 37%, whereas volume has grown more than 40%. So I think that will be the trend. We will work on more volume and more width in our stores during the festival time, because higher will be the width in the store, more will be the sales in the festival time.
Could you give us a character of the way revenue will shape up going forward in terms of how much will come from core markets, which account for 85% of your sales, private labels are 45% of your sales, and the men-women split is fairly even, 40% men, 30% women, nearly 30% kids. Will this continue, this mix, or are you expecting any significant change from this?
So right now the mix 86% revenue comes from apparel section, and 87% comes from apparel section, and 13% comes from general merchandise. Out of 36 comes from men's, 28 comes from ladies, and around 22 comes from kids. So this is the mix for us.
All right. And net debt, where do you target that to be by the end of this year?
So I think the mix will remain similar only. 87% revenue will be coming from apparel section only, and 13% will be coming from gen section only.
No, I was talking about net debt.
Okay, on the net debt will be on the similar lines that we have posted this year. This year, I think the net debt was around 104 crores, and it will be on the similar lines for this year also.
All right, take that point. Thank you so much for joining in and giving us an outlook on this year, and wish you good luck for this year, be it Eid, Diwali, wedding season, festive season, better monsoons. All of that works well for value retailers. 25% plus growth with 7 to 8% same-store sales growth. 14 to 15% margins is the broad target for Bazaar-style retail. Let's get in Deven Choksi on the show as well. Thanks a lot, Deven, for joining in. Good morning. Value retailers, we've got the update from Avenue Supermarts, we've got the update from V-Mart, we've got the update from players like Bazaar-style retail as well. And the consumer sentiment, by and large, looks like it is improving, especially on the staples and beyond Metro's space. Would you bet on any of these players right now?
Yeah, Mangalam, good morning. Well, I think it's important to know that, yes, I think the rural demand is picking up, most importantly. Consumer is spending money on different types of format. I think the larger retailers are probably attracting the consumer for the high value-added formats, as well as I think the smaller retailers, I think starting from grocery onwards to apparels, I think they are attracting consumers. The most important part is that on a per store realization basis, I think most of these companies are talking double-digit growth. And that's where I think one could possibly argue that they're leaving more money in hands of consumer is definitely resulting into higher spending power. Now, whether I think this is immediately reflecting into the kind of a buying opportunity of any of these stocks, I'm not completely sure on that aspect, because most of these companies are fairly valued. In fact, I think they are comparatively valued, I think, in rich valuations, taking benchmark of demand. So frankly, I think I don't see the opportunity immediately in buying those companies, because I think the valuations are already at scale level at this point of time.
Got that. Deven, morning. First off the block in terms of earnings will be, of course, IT services. I mean, it's been a pretty, except maybe one or two, the mid-cap companies like Persistent, Coforge. You can look at it, look at the data over the last many quarters. Everything else has been very small growth of 1%, 1.5%, some decline even. You think similar kind of quarter this time around as well? And any trades here in the IT space?
Hi, Prashant. Good morning. Well, I guess I think the larger IT companies are still trying to find its space in the bigger order wins that they are targeting. Current year also, I think, has started, but I don't think that immediately we are getting many signals from these from America or from other markets of the world, where they've been watching out for getting the larger part of the orders. I think that's not immediately being seen. However, in the mid-tier IT companies, particularly those which are into the engineering R&D space, they continue to attract a good amount of attention because they are a B2B solution provider to most of the companies in their product programs. And that's where probably I think these companies are relatively sure of, I think, higher growth. What one is not fully convinced about is the valuation. Again, I think all the mid-tier IT companies, even though they are growing in a double-digit growth, they still do not have the kind of a valuation advantage in marketplace at this point of time. So yes, if you're invested, I think you better stay invested. But otherwise, I think the fresh buy definitely at a lower levels, I think would be more recommended in my view.
Where does fresh buying happen according to you right now? What sector looks interesting?
So I think we continue to like the manufacturing, which is connected with the high-end part of the manufacturing in supplying to, say, for example, railways, supplying to, say, for example, defense, supplying to the power and power utility businesses. That's where probably I think our conviction level remains high. Yes, I think the larger companies are fairly valued, so there is no argument on that aspect at this point of time. But some of the smaller players who are basically mid-sized to small-sized companies, which are now fitting well into the entire growth program of these particular verticals. In my report, I think they are the ones I think who are getting into the opportunity space at this point of time. So this is one area which we continue to like it. The second area, as I was mentioning, is about engineering R&D space. That's where the companies like Tata Tech in particular, or Tata Elxsi for that matter, I think they are looking at relatively more stable companies from an investment point of view. However, I think they will be reflecting higher amount of growth in this year in course of I think next couple of quarters, wherein some of the projects are going to start materializing into billing part of it. So we like I think that proposition available at a comparatively I think a lower values at this point of time. Similarly, I think we continue to like some of the the top level NBFCs like some Bajaj Finance, Bajaj Housing Finance. There, the growth rate is in excess of 25%, and they are growing, I think, at a steady pace. A little bit of valuation expensive, but again, I think they are giving good visibility for next 3 to 4 years from a perspective of doubling the upside, etc. So
manufacturing plays, engineering plays, and good quality NBFCs. Those are the three places which you like right now, right?
Yes.
Do you have a view on some of these real estate names? Signature Global, for instance, reported its first quarter update, 63% value growth. We've seen good performance continue for the real estate space. Do you think, we're towards the middle of the cycle right now, towards the end of the cycle? Where do you think real estate stocks and the underlying cycle is?
Yeah, I think, Mangalam, we find that I think the companies which are typically focusing on redevelopment projects are relatively better off at this point of time because I think they know how exactly I think they're investing their money in the construction area of activity. And they can focus well on selling part of it. I think somebody who is carrying the land parcel, we are not completely sure because I think they end up selling either the community living kind of projects or they end up selling some of the mass housing kind of projects. We are more comfortable with real estate companies which are in the premium segment of housing. We believe that I think that's an area where probably I think you're likely to see higher amount of growth and realization apart from getting better income on your investment that you do, that is return on equity. So we love those kind of companies more. At this point of time, maybe I think some of the new companies which are entering into the IPO market, they may be also equally a compelling proposition in the real estate space. But listed space, I think more or less companies are priced adequately at this point of time.
Okay. That's on real estate. Devin, hi, good morning. What about textile and apparel? I mean, these companies have been waiting for their time under the sun for a long time to really become huge global players, right? And who knows? I mean, the tariffs are changing every day, but we know Bangladesh is at 35%, Vietnam is at 20%. If somehow India can manage a tariff less than 20%, then this could make the sector very interesting, won't it? Do you like any players here?
So we all have, I think, good amount of expectation on this front, and I don't think that things are immediately seen happening in my view. But even if I think one has to assume that I think we would be having the advantage of tariff, do we have the large size facilities, I think, which can give equally better amount of output? I think one is not completely sure. Maybe significant amount of investment may be required in some of the units. I think that's what I gather. At this point of time, I think we as investors, I think don't like this particular sector because it is too much vulnerable, I think, in different spaces, I think, including the one's current situation in which we are. Suppose if everything materializes, nothing like it, but it will be a 3-year story to roll out that kind of a business. We will wait for some time.
Okay. All right. So wait and watch till we have actual proof on ground and the final tariffs themselves. Got it. Thank you very much, Devin, for all the thoughts and ideas. We need to take a very quick break on that note. Coming up on the other side, we'll have Sudarshan Sukhani and Mitesh Thakkar joining in with some technical trading ideas.
Welcome back. Well, I think you've got the market, which is 7 minutes away from the pre-opening. Sudarshan and Mitesh are with us with what they'd want you to do in terms of the start this morning. Gentlemen, great to have both of you here. Markets have quietened down, although with the sensex expiry, you saw a little bit of excitement with that sharp spike towards the end yesterday. Mitesh, what's the advice? How are things looking? And is this going to be, once again, back to sort of a quieter session, ranged in that sense, at least on indices, and then we'll get to stocks.
Yeah. So, good morning, Prashant. I've been actually suggesting that, we are going through a contraction phase, and that is how things are playing out. It is a market, which after that hitting that levels of 25,200 plus has kind of come back and now is, showing signs of situation when the volatility indicators are turning flat. The moving averages are turning flat. So it's a market, which is not giving clear-cut directional signs. My sense is that this could mean that few more days of range-bound activity could happen. The threat would come in case we break 24,200 on the downside. But as of now, that is also something which I'm not very sure about. So we'll just believe that the markets will move around within some kind of a trading range.
And that trading range has become as narrow as, like Mangalam was telling us, taking an average last couple of sessions, 100 points, 150 points, barely going to 200 points. It's quite something. Morning, gentlemen. Sudarshan, so yeah, we're in that kind of a market where a 10-point move on the Nifty, you have to keep seeing, and then eventually it may happen. But what are you doing? Any index trades at all, or is it all stocks?
Yeah, good morning. I think there's an index trade now coming up. See, for the last many days, we have been in a narrow range. You just spoke about a 100-point range, 150-point range, whatever. That range cannot last for long. I think we are now on the verge of a significant move in the Nifty. Unfortunately, I can't predict whether it will be on the upside or the downside. Usually, I would have said up, but we don't know this time. I can give you some support and resistance zones somewhere around 25,550. If we cross that level, then we are breaking on the upside and we should be positioned on the long side once those levels are touched and crossed. On the downside, I have something around 25,425. This is a 125-point range where no trades are possible, either above it or below that 425 level. I think a significant trading opportunity will emerge.
Yeah, interesting, and we'll keep that in mind. And it seems from the market's mood that it wants to go higher. It's not falling. All kinds of fundamental negative news you're throwing at it, and it's not falling. But let's see. We'll take a very quick break on that note, come back on the other side, and then we'll get some stock-specific ideas with our technical experts as well. Welcome back. Just about 16 minutes before we kickstart today's trading action. Will the range break? Will there be some action in the market? Well, let's see. Talk about individual stocks now. Mitesh, morning. Let's get to your stock list.
Yeah. Morning, Sunil. I have a mix of buys and sells. On the buying side is DLF with a stop at 828. I'll look for targets of 870 here. Aditya Birla Fashion appears to have given some kind of a mild reversal, so buy with the stop at 78 for a first target of 82.5. A sell on Axis Bank with a stop at 1173, and it's a conditional sell. So if it breaks 1160, then take a short positions. Take a stop at 1173, look for targets of 1130. And Delivery is a buy with a stop at 399 for targets of 430.
Interesting one, Delivery buy. We have a Motilal Oswal initiating coverage on that stock today as well. From the lows, the stock has actually seen a big up move. So keep an eye out on that one. Thank you, Mitesh. Sudarshan, your stock picks?
Yeah, it's an all-buy list. ITC is a buy with a stop under 410. Balkrishna Industries is a buying opportunity with a stop under 2560. Asian Paints, despite all the adverse news, is giving a decent chart. So it's a buy with a stop under 2437. And finally, Cummins India is a buy with a stop under 3400. It's an all-buy list, primarily mid-caps.
Okay. Got it. Gentlemen, thanks very much for that. So those are some of the stock ideas that perhaps one can look at today. It's 9 a.m. The first of the rates are coming in. They're all over the place. So maybe we should just wait. Nifty in the first 9 minutes, at 900, it's suddenly down some 300 points. So let's wait. and see how it plays up. In the meantime, what we should do is perhaps take stock of a lot of the banking updates that we've been getting over the last couple of days. And the updates have been fairly mixed. Some banks are talking about double-digit growth. Others have been struggling in single digits. So let's discuss all of this with Digant Haria, founder at Green Edge Wealth Services. Digant, thank you so much for joining in. Just wanted to start with the Union Bank because that's what we saw after market hours yesterday, where the advances growth is, I think, 6.8%. The deposit growth is, just about 3.5% thereabouts. So it's really, it stands out in terms of weakness. And there were some other names as well. I think PNB on the PSU side, where the growth numbers were, at least advances, were in single digits. How do you look at PSU banks right now from a growth standpoint and the valuation standpoint?
Yeah, morning, Surbi. See, this entire growth slowdown started probably around elections of last year. So if you look at the credit growth data of India as a whole, it's around 9% for, like the YOY credit growth in that June quarter was around 9%. So see, when the growth is 9%, we know that maybe the private sector will grow at 11, 12 and the public sector will grow at 7, 8% because the system growth itself is 9. So I don't see this, PNB or, Bank of Baroda or anyone's performance as very, very ghastly or anything because, see, system growth minus 2% is what generally the public sector bank is used to growing. But yes, I think the system growth at 9% itself is a very, very weak number for a country like India. Like we should at least be at 12%. And now we see that, the whole macros, the RBI has, taken a lot of initiatives to ensure that this growth starts. I think that, 1 quarter later, like once the monsoons are over, the slow season is over, we should see this number improving. These are not great numbers, not something which instills confidence, but I think improvement is coming on its way, Surbi.
Digant, hi, good morning. Always great to get a perspective. And, what we like about speaking to you, Digant, is you pull back a little bit and then you sort of zoom in as well. So that's very useful. And NBFCs has been, a happy hunting ground for at least a few people. I was just, for example, looking at IIFL, right? I mean, underwent so much damage. The first time it started falling was that gold ban. It never really recovered, even though the ban went away. Went down to all the way to about 300 kind of levels, back to about 500 after many months. Is this a broader kind of a rising tide lifting all boats kind of situation, or it's more idiosyncratic, in your opinion?
I think, I'm morning, Prashant. I think it's a little bit idiosyncratic because, in NBF, when we say NBFCs, there are a lot of pockets. I think the brightest pocket is gold loans for the next 12 months. So just Surbi was just hinting that, 6, 7, 8% growth, and we were talking about credit growth of 9%. Really, really boring numbers. But I think gold loan as an industry, Prashant, this year can easily do 20% growth. And then good players can, easily do 30, 40% growth. IIFL, after a long ban, has come back. So I think growth will come back in IIFL. I think the stock price is yet to react. Like the Muthuts and Mannapurams and Fed Finas of the world, they have reacted to a good gold price, a good RBI policy, and a good gold demand environment. IIFL hasn't. I think it should over a period of time because, once RBI ban is lifted, getting the liabilities or getting borrowings takes time. And I think IIFL is sorting those issues out.
And in NBFCs, actually two questions. In NBFCs, what are your top 1 or 2 ideas? You like IIFL clear, I think so. But what are your top sort of rated ideas? And broadly, if the RBI is trying to jumpstart this credit cycle, in a way, the NBFCs are clearly higher risk in that sense as compared to banks and the top tier banks, which are much more stable. But this is where perhaps you make a little bit more in terms of alpha. What's your sense?
Yeah, absolutely. I think, if one has to bet on financials, Prashant, I think, PSU banks is something which gives 10 to 15% returns because the cycle will pick up, over the coming months. But I think NBFCs is something where, people can look for alpha. So just like we said that, gold loans as a space is probably the fastest growing and the best placed space. So, anything in gold loans should, generate decent alpha for the investors. Similarly, like, there is one sector which is an avoid, which is a commercial vehicle finance, okay, or the CV finance. I think that we have finished 3-year cycle. So we will see that as, going very, very slow. But the space which I like, apart from this gold loan space, is something, which is in that personal loan, microfinance, this entire high yield lending space. That's because, this space has gone through a lot of pain. I think now the asset quality cycle is coming to an end. The regulatory cycle is improving and the demand environment will improve in the coming months. So I think this entire, banks and NBFCs which are linked to high yield lending, something like, say an AU Bank, or an RBL, on the banking side, those will see the biggest alpha in terms of earnings. And, when we talk of NBFCs, companies like, say, a Northern Arc or a Fed Fina, or, even say an Ujjivan Equitas, something like that.
We've seen an up move in Northern Arc earlier. We had the management join us last week. They said that 22 to 25% growth is what they're expecting. So, Digant, what your point is that loan growth at some point will pick up, but yields will pick up a lot faster because loan growth which picks up will pick up on the high yielding sides as well. The concern that one had was a lot of the people who are getting fresh loans are the ones who are already leveraged. At what point does this net widen and you go to underserved places, and what companies benefit the most from that?
Yeah, so I think, see, this whole, Mangalam, this whole space below 50-60,000 of ticket size, that is a space which is really over leveraged, and that problem is still not over. We are still in that problem because the incomes of those customers are not going up. But I think, the space between that, 1 lakh to 5 lakh kind of a personal loan ticket size, that space should really do well because, some amount of deleveraging has happened there, and this entire tax cut by the government and this rate cut, this benefits this space. So I think Northern Arc is is very well placed to ride this boom. Then, even something like a Federal Bank Financial Services, it's an NBFC of the Federal Bank Group. I think they are into this high yield lending. So they are into gold plus small lap plus, some bit of business loans. So they can also benefit out of that. Something like an SBFC, there are a lot of small names, Mangalam, it's a buffet out there.
So smaller names is what you're betting on. Where do you stand on the PSU versus private banks debate right now?
Mangalam, I think, the entire large cap space, be it the top 4 PSU banks, the top 4 private banks, and the top 4 NBFCs like, Bajaj, Chola, Shriram's, I think all of them will give you market returns, maybe 10 to 15%. There is no real big case of saying that this is better than that. I think everyone will suffer this slow credit growth in India. It is only the smaller guys who can really outperform in the next 1 year. At least that is our view.
Okay.
So no great picks in, all the large caps. Maybe you can just invest in a large cap banking ETF or something. You'll get your market returns out of it.
Yeah, so the alpha is in the tier 2, tier 3 names, and that's why the perspective that you gave really helps. Guys which are very granular with respect to MFI, high-yielding consumer businesses, gold financiers. Got that. So really helpful takeaways. To wrap it up, Digant, the market also loves to play some turnaround stories. And everybody wants to make a huge killing by buying out stocks that are in distress. And here we're talking obviously about IndusInd Bank. And everybody thinks that you buy the bottom and then you have a great story to tell a couple of months down the line. But I don't know how that could play out because there's a lot that's still that we don't know. The forensic audit is not done. And if you look at the numbers that the bank has been posting, I mean, all of this is taking a toll on the business. Advances, deposits, everything's been falling. Your thoughts and what would your word of advice be to investors who've been looking at this name?
See, I think, Surabhi, there is no pot of gold in IndusInd Bank, to be honest, because right now we have just identified a few areas of problems. Now, fixing it itself, it will first require a new MD to come. Then the whole new team will come. They'll start to work. So I think it's a long journey. And see, the stock has, been quite firm in the face of all this bad news. So I just feel that, this is like a trading range kind of a stock where, 750 to 1,000 or, 700 to 1,000 is where the stock trades at, depending upon what kind of news. But business is really, really affected, and it takes 4 quarters for it to revive, even if there is a good cycle. So I think you're better off hunting somewhere else. I think IndusInd is for the traders, who like to trade volatility. I think for people who want to buy and hold for a cycle, say 1 year, 18 months, I think there are better, smaller bets, to take than IndusInd Bank.
And you've given us some names. I'm just recapping: AU Small Finance Bank, RBL, IIFL, Federal. Some of the companies that Digant likes. All right, Digant, thank you very much. Great conversation. And we look forward to the next one as well. Okay, let's quickly, check back with the market, which is now as quiet as ever. Nothing really has changed. So about 8 points down on the Nifty, and the Bank Nifty is also absolutely flat at this point. Let's go back to our technical experts for the technical ideas. Sudarshan, what would your call be? 910?
Well, it will be Cummins India buy with a stop under 3,400.
Okay, and Mitesh, yours?
Well, you go with a buy on DLF for targets of 870.
Okay. So, yeah, I mean, lots happening. Let's just look at names like Vedanta, etc., right? I mean, those copper tariffs. If we can just quickly pull up as we wrap up the pre-open session, I think 1% higher on Vedanta. It's just the US which is the problem. But, and of course, and the timing in terms of effectiveness is uncertain. The rest of the world, of course, is open in that sense. Let's shift focus to a slew of brokerage notes which are coming in on a select real estate names. And, of course, the EMS pack as well. Sudarshan has got the top ones here. So, good morning.
Morning, Prashant. So we have few stocks where brokerages have initiated coverage. So first one, Nomura has initiated coverage on Godrej Properties, and their call is reduced and target price is 1,900 per share. It believes that pre-sales momentum are going to be weak, and in FY26, pre-sales are expected to be rupees 31,000 crore against company's guidance of 32,500 crore. Also, it believes that challenges to execution in Godrej Properties are very much visible. On Phoenix Mills, it has initiated coverage, and here also the call is reduced and target is 1,400 per share. It says there is a slow consumption growth in mature malls, and retail consumption CAGR by FY27 is expected to be 9%, and by FY30 it's expected to be 11% versus 40% that company did over FY22-25. Last one, JP Morgan has initiated coverage on EMS companies. It has an overweight call on Syrma, Dixon and CAMS. For Syrma, target price 800, Dixon 17,700 and CAMS 7,150. And it has a neutral call on Amber Enterprises and Cyan DLM, and underweight on Avalon. For target for Amber is 7,350, Cyan DLM 450 and Avalon 650 per share. For Syrma, it believes that company is expected to see a growth acceleration and expansion on margin front. For Dixon, it will be mobile-led growth till FY27, and beyond that, it would be led by non-mobile. For CAMS, it may see fastest growth amongst all the EMS companies. That would be 46% CAGR over FY25-28. And for Syrma, Cyan, DLM and Avalon, exports could be the next leg of growth driver.
All right, Sudarshan, thanks a lot for that. So those are a bunch of initiating coverages. But looking at the consumer staples and paint companies, we've been speaking about how, brokerages are now turning positive. Jefferies has written on consumer staples. They've said that several consumer firms have faced severe issues in the past few quarters. There have been issues regarding growth, margins, as well as competition. While some of them are abating, which is growth and margins, competition may persist, but these stocks have factored that in, and they believe that from here on there is more upside and less downside, which is why they've upgraded both Varun Beverages and HUL and Asian Paints as well to buy from underperform, and they've upped their target price as well. HSBC, on the other hand, has specifically written on paints. They've said that their market checks suggest dealer incentives have achieved broad parity across players. Basically, all players are giving the same thing to every dealer. And from here on, for Birla Opus to go ahead and do that 10,000 crore revenue target means that they have to sell a lot more per tinting machine versus what they are right now, which is a very big ask. So we need to be mindful of that. They remain optimistic about the underlying industry growth improving in the second half of this year. Asian Paints, their buyers on that, target price up to 2,900, and Berger Paints, buyers on that, target up to 640.
All right, we got the first rates which are starting to come through, and we've got the market open absolutely flat. My God, I mean, will it be, under a 10-point day, 25,510 on the Nifty. And it's got nothing on it. The Nifty Bank is absolutely flat as well, 0.1%. The 57,200 is where we're at. The small cap index is up a little bit, but it's barely in the green, 0.12. And I think you've got the mid cap index, which is starting up about 10 points as well, but it's absolutely flat there as well. So, yeah, I mean, not very much to go with as far as indices are concerned. 1,100 stocks are higher, 500 stocks are lower. The Nifty heat map up on your screen. So you've got about, 22 names which are lower. Bulk of it, though, is in the red at this point in time. It's actually FMCG. I mean, so Monday you had FMCG index up 1.5%. Lever Asian Paints are the two names which are on the green side, and some tech names are in the red to begin this session. Surbhi.
Okay, 29 points lower at this juncture. The weakness is coming in from a couple of IT names. Wipro is down 1%, Infosys is down 0.5%, Tech Mahindra is also starting lower. HCL Tech is down 1% as well. So IT is getting nervous ahead of the earnings. L&T is seeing about 0.5% shave off. Mahindra & Mahindra is seeing very mild profit booking. Titan, by the way, that was down 6.5% yesterday, is down another 0.25% this morning. Trent is also slightly lower. So that's the losers list. Let's look at the winners. HUL, 1.5% on the upside, up and about. Asian Paints, 0.7% higher. Mangalam was just telling us about some of the broker notes, which are sounding a little more optimistic on the paint sector now, on paint stocks. There's Geo Financial, there's Cipla. By the way, let's pull up some of the pharma names. Cipla is up. Dr. Reddy's is down 0.25%. There's no meaningful move on pharma because anyway, I mean, you heard that soundbite from the US president. He was saying we could put 200%, but it's in the future. Want to give the industry some time, etc., etc. So nothing concrete. So pharma seems to be all right for the time being, but it's more down than up. Eternal is also lower. So very clearly, the trends are more, defined on the downside this morning. 30 points lower now. 35 points lower, actually, on the Nifty now. Mangalam?
Both of you all are sounding like the first 20 minutes of a classical concert where an alap happens, not much in terms of stuff, but there are a lot of nuances under that alap, and that's exactly what is taking place right now. You know, the Nifty, the frontline indices absolutely flat, marginally lower, but look at the nuance out here. You have the consumer staples doing well. We've been speaking about how Jefferies has gotten positive on, HUL, Asian Paints, as well as Varun Beverages. All these stocks are among the top gainers, not by too much, but gainers nevertheless. We are seeing some traction on, Berger Paints as well. HSBC is written too. But Union Bank, weak update coming in. That stock is down 4.5%, 5% straight off the bat. While a lot of the other pharmaceutical companies are doing well, the domestic ones in particular, the ones that have foreign parentage are not doing very well. So Pfizer, for instance, down about 4% at open itself. And then we have, I'm looking at Sun TV, wondering whether there is a move on that one on the back of an alleged truce between the brothers, the Maran brothers. That stock too has opened about 1% higher. Dish TV, 5% higher. The Z Group stocks have been doing well. Obviously, it's a 5 rupee stock, but Religare is the other one, which is up around 5% as well. The hospitality companies continue to do well. Sami Hotels is one of them, which is up around 2.5%. Then you have Garden Reach Shipbuilders, the usual suspects, the ones which are higher. And on the lower end, we have Phoenix Mills, Godrej Properties, and Dream Folks, which continues to see some traction on the downside. So it's an alap with a lot of nuance in the broader markets. And the movers aren't very big when it comes to volume. So maybe towards the end of the concert, there is some more percussion that comes in.
जिनकी हिंदी थोड़ी तंग है, आप उसको उनके लिए बताइए अलाप का मतलब क्या है?
अलाप
हमें तो पता है, पर आप बताइए.
मुझे खुद भी इंग्लिश में मैं अलाप नहीं समझा सकता because it's a Hindustani music concept. I don't think the foreigners have, got into the greatness of an alap.
Well, let's just hope the market picks up from that alap and moves to a nice crescendo. So to use a English word when it comes to the music world. But yeah, by the way, I think it was a JP Morgan upgrade on a lot of EMS stocks, electronics manufacturers. Sirma is up about 3.5%. Dixon & Keynes also on a lackluster morning, managing about 1-2%. So this space is a little buzzing and active today.
Absolutely. We've got 1,400 stocks higher, 800 stocks which are lower at this point in time. Vari Energy, I think it was up yesterday as well on decent-sized volumes yesterday. Yeah, actually, volumes did pick up on Vari yesterday. So Monday it closed at 2,900, yesterday at 3,100, and it's up a little bit, 1.5%. It's the largest, the number one volume traded gainer on the NSE. So that's the reason I'm mentioning it. And of course, a name like JP Power, I'm not sure what's happening here, penny name. But JP Power was up 20% on Friday on Monday. Yesterday, it didn't go anywhere. It's starting 2% higher. That is Jayaprakash Power, JP Power, number 2 volume-led gainer on the NSE. So that's the other one. I think Mangalam already mentioned Sirma, etc. Sirma is up 3%. A name like Religare is coming up, 4% higher on Religare. Again, I mean, the Burmans are in and they're in the driver's seat in Religare, but stock has not really done very much. I've heard from many the downside is limited, but I mean the upsides have been hard to find here for a while. Maybe it'll come, but that's Religare for you. Lal Path Labs is up 2.5%. SW Solar is up about 2.5%. So it's low. It's low in terms of the price action and volumes right out of the gates, at least as you look at things at this point in time. All right, well, let's talk about the markets in some more detail. Karthik Kumar is fund manager at Axis Mutual Fund. He's with us. Karthik, great to have you with us here in the program. Good morning. Thank you for your time. How are things set up, Karthik? I mean, just in terms of the price action, momentum, or the lack of it for the last few days now. What have you been doing, and your thoughts on the market structure itself?
Okay. So actually, if you look at it over the last 6 months, essentially the markets have done fairly well, considering that we've had geopolitical tensions and economic tensions because of tariffs. And in that context, what we saw was market taking umbrage under value as a style, and value did quite well over the last 6 months, whereas traditional momentum growth, these styles kind of took a backseat. However, over the last 2 months, what we've seen is a much more risk-embracing style where high volatility, high beta stocks have done well. Momentum has been the better performer over the last couple of months. And we've also seen that in terms of cap space, where while over the 6 months, small caps and mid caps have lagged, over the last 2 months, we've seen sort of a comeback by small caps and mid caps compared to large caps. So I think there has been a bit more risk appetite that we've seen over the last couple of months. And that was because of certain policy certainty, that was because of a pro-growth stance both by the central government and by the Reserve Bank in terms of taking proactive steps. And all those things, I think, kind of helped the risk appetite over the last couple of months.
Okay. All right, got that. Thanks for joining in, Karthik. Good to have you on. So investors are really wondering what next, because now we're within striking distance of the all-time highs. And, one is looking for further ammunition. So which are the sectors where you think growth could come through? Because there is no better fuel for a bull market than actual earnings growth. What are you most optimistic on?
So I think the growth sentiment across industries and across sectors should improve going forward for a couple of reasons. First, in terms of we've got a favorable base where last year was elections, so the activity was on the muted side. Plus, we've got actions by RBI that essentially have ensured that interest rates are lower, liquidity is higher, plus the tax relief that kind of kicks in. That's from a macroeconomic standpoint. And also, if you look at it purely from an earnings standpoint, we front-loaded a lot of the earnings cuts for FY26 over the last 3 months. And which is why I think going forward, and the extent of earnings cuts have been intensity of earning cuts have been quite significant over the last 3 months. And I don't expect that to persist. So I expect earnings environment to progressively improve over the subsequent quarters, and which I think will prompt the market to kind of look at good return opportunities in the near term.
All right. Where do you stand on the entire consumption, space conversation here, Karthik? Are you betting the discretionaries which are likely to outperform when the stocks are highly valued, or are you looking at some recovery in the staples where the stocks have seen a lot of time correction and maybe things are improving for the better? Where do you stand on that?
So we still like specific themes within consumer discretionary, especially with related to hospitality, travel, tourism. But in terms of traditional FMCG, we are yet to see an uptick in the underlying data. The earnings previews that have come in so far kind of reiterate that point, where we've still not seen an uptick both in the rural and the urban side. Commentary is getting better depending on which company you're speaking to, but largely we are yet to see it in terms of earnings upgrades as well. So for now, we'll still stick to our conventional themes, but at some point, the consumers, the traditional consumers, will also become attractive once we see an uptick in earnings estimates.
Yeah, no, absolutely. Makes sense. You know, we were just having this discussion with Digant earlier on, and he said, well, NBFCs is one area which is perhaps a space in financials which offers opportunity. I mean, would you kind of agree with that, Karthik? I mean, and what kind of positions do you have? What segments really, broadly?
We are positive on financials, partly because of the fact that we are still seeing a mid-cycle kind of valuations there, and the fundamentals for the sector are turning positive for the reasons I already elaborated on. And within financials, we like both the private banking space, and we like NBFCs. We like both categories, so we have a reasonable exposure across that spectrum.
Okay. Karthik, on the manufacturing side, manufacturing, Make in India, because there's such, huge shift going on, right, between the whole realignment of global supply chains as well. Specifically, are there any verticals that you would be optimistic on?
We remain, while the whole policy action in the West and the ramifications still need to be watched out, but we need to watch out for. But in the near term, we remain positive on power, T&D. Those are the areas that we are kind of bullish on.
Okay, power and
space.
Power and T&D. Okay, utilities part of that category?
Somewhat, but more T&D place, I would say.
And valuations are comfortable?
Valuations are reasonable. I would say market, we all know our market itself valuation is at the higher end of the spectrum. So, which is why I would argue over the next 3-4 months till we see an uptick in earnings, the market is likely to be range bound. So I think that applies across sectors as well, largely.
In the auto space, is there something that you like? Are you looking to play this? Because, the per capita auto is still the lowest in the country from a macro standpoint. But a micro standpoint, the largest player has been losing market share because SUVs and, bigger cars are seeing more sales than entry-level cars. Then you have the two-wheelers, then there are the auto ancillaries, then there is the one which is exposed to global markets. So there is uncertainty there. How do you play this?
So with autos, we've kind of trimmed our exposure through time. We have selective exposure to autos through some that have exposure to the segments that you talked about, which are largely the beneficiaries within the four-wheeler space. So we do have selective exposures both in the four-wheeler and two-wheeler space within autos. But overall, we've trimmed our exposure through time because if you look at the sales trends, if you look at earnings trends, expectation trends, all have moderated, and valuations have kind of are full as well. So we've kind of trimmed that exposure and are more selective about it in that space.
Okay. All right, Karthik, good conversation this morning. Thank you very much for joining in and giving us your perspective on the market. The market's actually okay, 40 points lower on the Nifty, but one stock is definitely catching my eye at least, and that's BSE. BSE has made a sharp move from its very flat opening. Now the stock's about 60 rupees higher. And it seems to be trying to recover some of its loss yesterday. It was down very sharply yesterday as well. Well, speaking of BSE, let's talk about what lies ahead for whether it's exchanges, whether it's market participants, and of course investors themselves. We're talking about all the ongoings in the futures and options market. Retail investors in India lost over 1 lakh crore rupees in the derivatives market in FY25, and about 91% of these individual traders lost money in F&O. This is according to, of course, the latest study released by market regulator SEBI. Let's discuss this and the way forward with Gaurav Seth, Managing Director and CEO at 5 Paisa Capital, and Ashish Rathi, Whole-Time Director at HDFC Securities. Ashish and Gaurav, thank you very much for joining in. There's just so much going on in the futures and options market. The last 1 year, we've seen the regulator tighten a lot of the screws. We've had the whole drama play out in terms of expiries, now reducing the products to one per exchange. And this morning, there are reports suggesting, I think the Mint put out a report, that maybe they'll look at, instead of a weekly expiry, now a fortnightly expiry, if they're not satisfied with the reduction in just the sheer amount of speculation. Your thoughts on, first of all, whether the F&O market needs further tightening? Ashish, let's open with you.
So in terms of tightening, you will see a lot of measures have been taken already by SEBI. I think so there's an October 1 circular wherein 5-6 measures have been taken, which came into effect mostly in the last quarter of last year. But yes, in terms of tightening, so the major concern is on the retail side. So one kind of tightening which we can look at is a product suitability test. Depending on the risk appetite of the customer, maybe he is allowed to take positions in derivatives. I think so that is where we will reach a situation wherein, okay, you have the risk appetite, then you are allowed to take that risk and you understand the risk better. I think so that would be a good thing that which SEBI can look upon it. In terms of structural measures, a lot of things have already gone about, making from 5 expiries to 2 expiries, then increasing the margining, upfront collection of option premium, plus all these market-wide limits. A lot of measures are already in place or still in the process of implementation. So we can wait and see for some which are still in the process of implementation, what is the impact. But yes, in terms of retail investors, product suitability test is something which SEBI can look at introducing.
Ashish, this is a very interesting, just Ashish, allow me to come in over here. This is an interesting concept you're bringing in. I don't know, does it exist in any other major market worldwide? And then the onus will be on whom? You know, maybe SEBI can design a test. How do you design it? How do you decide if, you know, F&O trading is suited for me or not? And maybe it is for Prashant, maybe not for me. Anyway, we don't trade. I mean, that's aside because of our regulations, internal regulations. None of us actually trade in the market. But how do you decide it? Will the onus be on the broker? Can it really be a feasible solution?
Yes, it can be a feasible solution. So you take the inputs from the customer, depending on your net worth and everything. Then you take the risk suitability. Okay, so how much is the risk you can bear? Basis your risk appetite, you may be quantified as a high risk. You are ready to take high risk with. And basis that, and depending on your net worth and everything, you will be allowed exposure in derivatives. So that can be worked out. Maybe in stages, at an initial stage at a lesser level, at a later stage, maybe at a higher level. So these things can actually, then what happens is the customer himself is declaring, yes, I'm ready to take riskier bets. And then even if he make losses, I mean, the understanding is that he has understood it much better.
All right. That's an interesting point that you're bringing to the table. Let's see whether that gets implemented or not. But let's, bring in Gaurav in the conversation as well and to see how things have changed. Gaurav, there was a serious amount of trading and speculation in F&O that was taking place. And a large part of that, whether it gets attributed to, the underlying equity cult or not, definitely gets attributed to the surge in discount brokers and access to market by itself. Could you give us a sense of what proportion of your volumes right now, traded volumes on 5 Paisa, come in from F&O? How has that number changed over the last few months ever since tightening has come in from the regulators? And once there is a higher tightening, which is on the cards right now, as discussed by a lot of people, will that impact your business a lot more with options traders looking to come down from here on?
So look, I think I just go back to your earlier question. I think this is definitely a wake-up call, but also in terms of, I see this study coming from SEBI, which was published recently as a follow-up to what was done last year, right? A lot of the tightening and a lot of the structural reforms that the regulator wanted to put in place were already put in place. And of course, that did have an impact, not just on us, but across the industry, and which is a fact to see, right? So the volumes were impacted temporarily. So if you look at volumes compared to last year, we are lower, and a lot of our peers are lower. But if you look at it from the last 2 years perspective, it's actually higher. So while I think discount broking and platforms like us have played a great role in bringing access to the market, I think what needs to be spelled out here is that whether it is F&O or whether it is any other kind of product, right? I think the mandate of actually figuring out whether this is right for me or not, which I think even Ashish was talking about earlier, instead of pushing it to the brokers, it should also be in terms of how am I educating the customers? What is it that we are doing as platformers, as brokers, to upskill some of the people who are coming into the market, so they can figure out for themselves. So in any case, after last year, so the moment you log into a platform, every single time, you have an acknowledgement that is done by retail investors, any investors, right? Those 6-7 points which are where if 9 out of 10 people lose money and so on and so forth, right? I don't know how much impact does have on people, right? I think over a period of time, it is for you to self-realize that, right, is this working for you? What is the level of skill you have? What do you need to do, etc. And I think we as brokers and as platforms have to play a major role in that.
No, well put. Gaurav and Ashish, morning. Prashant here. One thing is clear, and then of course, all of this we're talking in the backdrop of that Jain saga, right? Which has happened, and it's kind of still, in a way, amazes me that many are still talking about whether this was. Of course, I mean it'll have to be proved in court, but the simple point that a normal player in the market would try to buy or sell with minimum impact in the price, right? But if the business model itself is to impact the price, I mean, I think that is where that SEBI order sort of comes in from. Let's just Gaurav talk about what else can happen. There are reports this morning, for example, that this is not one and done in that sense. On the option side, the regulator wants to. And we have that report also which shows how many people have lost money. So there is perhaps more action coming in that sense. One proposal perhaps is the regulator may revise the weekly contract expiry schedule. So from the current weekly, they may go to fortnightly. Gaurav, any thoughts on this?
Well, I would not like to comment on what the regulator is thinking. I think they probably know better than us, and in terms of like what are some of the decisions they want to take for overall market stability. However, I would like to make a point is that again it really boils down to people figuring out for themselves where they are in the spectrum, right? If you look at and I actually to be honest, I have not read every single page of the report, but I was glancing through it and went through this 33-page report. Where there is a statistic which shows certain correlation to how much money you are making based on what your income level is, right? As an example, declared income now on paper, and what that shows is, while you can't say that people with high income are necessarily better traders or people with low income are necessarily inferior traders, but the fact is how much how much thought you are putting into what you are doing. And actually be clear about where you are in the spectrum, what you need to do to get to become a profitable trader, and so on and so forth. I think once that culture comes in, where people sort of self-analyze over, I mean, there is enough data out there. There's no dearth of data. Like anyone interested in figuring out.
No, Gaurav, you've done this a long time as well. This is if reports. I mean, and this is. I'm not saying this is not necessary. Absolutely necessary, but it's at the end of the day, it's an addiction. I can put it bluntly. You lose money, you make money, you can't step away, and I think we all kind of recognize that. So that is the reason why I'm saying. I mean, as some of the news reports suggest, they perhaps may look at additional measures. Awareness, self-realization, etc., as both of you said, is one thing.
That we need to have for a lot of things in
life.
For
a lot of things in life.
But we may not.
But it doesn't happen.
So you need regulation.
So, Gaurav, again, my point is, you said, yes, it is for them to decide, but you think, the cost-benefit in that sense. Some would say, what about liquidity in markets, depth of markets? Others would say, perhaps, this is more important. So that's what my question was, Gaurav. Gaurav?
Yes, sorry, could you repeat?
No, my question was with regards to going from weekly to fortnightly, the argument, the cost benefit in that sense. How do you look at that? If this were to happen, of course, the regulator knows best, as you began by saying, but what is your view?
So my view is that obviously it may have some impact on the volumes in the short run. But as we've seen, if the data is to anything to go by for the last 1 year, volumes start to return to normal in the course of time. I mean, if you're asking me a specific point, what my personal opinion is, whether it is going to be weekly to fortnightly, yes, it could have an impact. Definitely, it could have an impact on the volumes in this segment.
Sure. And, gentlemen, what we've been discussing is so far the regulator taking all of these tightening measures to curb what it feels is perhaps excessive speculation leading to retail losses. And that is a separate debate. I mean, whether the regulator should have a moral view on this or not. But what my next question is that post the Jane Street episode, does this get another layer altogether? I mean, would we perhaps see tighter regulation or a change in some F&O frameworks to avoid what the regulator feels was market manipulation and abuse? And would you say, and I mean, I know this is going to play out over the next couple of days, but to say that Jane profited off retail traders and investors, would you completely agree with that? Because that adds a whole new layer of why we need tighter regulation, if that were to hold true in the courts of law. So quick thoughts on this from both of you. Ashish?
So in terms of, probably the episode in hand of Jane Street, they had accessibility to maybe you can say sophisticated instruments with which they did trading. Okay. So right now, if you look at whatever algo framework they could do, it's in the form of HFT. They had sophisticated instrument. And whereas retail currently, as things stand by, obviously effective August 1, they will have accessibility to algo trading and everything. However, that created some kind of an advantage to them. Plus, obviously, their appetite to have large money. Now, that is a structural advantage that they have and they will continue to have. Let's understand that. But however, in terms of regulatory measures, definitely the view is that we may see some measures in terms of some of the sophisticated traders benefiting out of retail investors. That's the understanding which everyone is getting. So we may see some measures. Now, whether these measures are structural measures in terms of making the changes to expiry, reducing the number of expiries, all things, or whether it comes by way of what I said is product suitability test at the retail investor. That needs to be seen. But yes, definitely what I think so after this episode, there could be some structural changes in the derivative. But as Gaurav rightly pointed out, so whatever structural changes are there, in the short term, you may see a blip volume, but in the long run, again, that it comes down to the same level. See, finally, it is up to people to decide, retailers, while they make losses, but as long as they know the risk about it, then it should be okay.
Not true. So just very quickly, Gaurav, same question to you. Because of the Jane episode, would you expect any more new stringent measures? And if yes, what kind?
Look, I don't want to speculate here, but I think just logically thinking, you could potentially expect some measures. What they would be, I mean, I'm in no position to comment. But again, I mean, if you look at the data, especially if you're looking at the report, like a lot of, I mean, it is very clear that a lot of the FPIs, the more sophisticated traders on the other side, as a proportion, made higher percentage of profits versus compared to a normal retail trader, right? So again, comes back to the same questions, the level of sophistication, your level of skill, and so on and so forth. So if you have to be in this market for a longer time, what is it that the retail traders do? And especially being a retail platform, I think that's the lens that at least we bring to the table in terms of thinking that, like, how do we do what is necessary for our customers? But what the regulator will do, we will see in the next couple of days or next couple of weeks.
All right, gentlemen, thank you so much for joining in and giving us this view. Obviously, it's at the end of the day up to those who are participating in this to know what their risk appetite is out here. In that, I would, believe that players like you would also, be responsible in informing the clients about what their risk appetite is and the product that you're offering, the risk nature of that product, along with what the regulators are doing to curb this speculation and ensure that everyone participates in this in a fairly equitable and knowledgeable manner, knowing very well what the underlying risk of what this offering is. Gaurav, Ashish, thank you so much for joining in. We'll invite you once again where we have more clarity on what the regulations are post this as well. Let's move on to another conversation then. We have Signature Global on our radar. The company has reported a steady first quarter business update. Sales and volume have declined year on year, but risen sequentially, while realizations have improved by about 33%. Let's discuss the business momentum and growth outlook. Rajat Kathuria, who is the CEO, joins in now. Quarter on quarter, there's been a big jump, 63% to be precise, but year on year, it's down 15%. Even the area which has been sold is lower, both year-on-year as well as quarter-on-quarter. You did have some sales from premium projects. This decline year-on-year, is it largely because of base effect? Or do you think that there is something underlying which has shifted a little bit in the real estate space?
No, you're right with the former understanding that it's largely because of the base effect. So last year, while we achieved about 10,300 crores of sales, the first quarter was the best quarter in terms of pre-sales for us, where we did about 3,100 odd crores. So we were competing against, the best performing quarter of the previous year. But in general, I think we had a fairly steady show. The last 3 months, we recently, just in the month of June, launched our first, new project for the year by the name of Cloverdale. This is in Sector 71, Gurugram, which is on the southern peripheral road and one of the key micro markets for us. And within a span of less than a month, we've seen a fairly robust sort of response to it. And we are, quite, happy, and, it's a good validation that, these new launches are seeing a good uptake in the market. So from our perspective, it's a good sort of, quarter where we've achieved more than 20% of the annual target.
Last year, the entire year was front-loaded with a lot of sales in the first quarter, like you pointed out. This year, you expected to be more back-ended because you've given us a target of 12,500 crores for the year. And the first quarter, you've done just about 2,500 crores. So the remainder of this year has to be, doing almost 3,300 crores per quarter for you to meet that guidance. So wanted to know whether that is happening. And secondly, on collections as well. While your sales have seen a decline, even the collections are lower by about 26%. You stand by your 6,000 crore collection targets for this year?
So on both the aspects, this year we have a sustained set of launches. So the best case scenario even for us is that there's not a lumpy quarter which we see during this year, and sales happen through the course of the balance 3 quarters. And that's our anticipation because there are quite a few planned launches. Like within this quarter, we are doing 1 or 2 large launches on the Dwarka Expressway micro market. As far as collections are concerned, this is in line with budgets. In terms of collections, we'll see a good spike towards end of Q2 and Q3 because some milestones of a few large projects are getting achieved around that time, and hence collections will not be as equally distributed through the year. But around Q3, we anticipate it to be a fairly good quarter in terms of collections. So the number is in line with budgets, business as usual, new projects seeing good uptake, new business development happening, and collections in line with budgets.
Are you sure about this being business as usual? And I ask this largely because from anecdotal evidence that we have and a lot of chatter that we get on social media, I'm not sure how credible that is, which is why the question to you speaks about affordability issues, especially in the region that you're operating in. A lot of them also speaking about something as direct as artificial inflation of prices and creating this sort of mirage that these houses are selling off like hotcakes because they're selling it to agents, etc. Just wanted to understand what your assessment of the situation in NCR is right now. Are prices anywhere closer to bubble territory? Is underlying demand under pressure?
Prices have spiked over the last 2 to 3 years, and that's why this conversation comes up very often, even on one-on-one basis. But if you really look at the prices over the span of last decade, you will not see them really spiking beyond a particular limit. Our per square foot realizations up just because we've launched a project which is at the most premium location of ours, and that's why you've seen a spike. Over the course of the year, this number per square foot realization is about to go down. So I don't think on an average prices are going up beyond 7 to 8% in any of these micro markets. So, this per square foot realization will come down. Now, with the kind of land prices and with the kind of commodity prices and the kind of product being offered, I don't think, price of, let's say, 13 to 14,000 rupees per square foot basis is something which is, obscenely priced or absolutely unaffordable. I think any given market across the country, these are the baseline sort of numbers which exist as of today.
Okay. Rajat, let's also talk about your overall expansion that you're doing. and what that will mean for the balance sheet. Because in the past, you've told us that you plan on becoming net debt-free by FY27. So just run us through, the cash flow position, how you'll be reducing this debt as you go ahead with the expansions.
So see, the net debt position is still almost static. We are at less than 900 odd crores, about 880 odd crores of net debt. 890 crores of net debt exists on the books at the end of this quarter. So that number per se doesn't seem very high to us. And in general, we are not we were never rather very highly leveraged. I would say that, as collections pick up, it's in normal course, this net debt number will come down. So there is nothing additional or very special effort which needs to be, made in terms of reducing this net debt. I would also like to add on that most of the land position which we have, in all of these key micro markets, which is, let's say, between recently launched and yet to be launched projects in close vicinity of 40 million square foot and, upwards of 55 or 1,000 crores of, GDV value. This land is mostly owned by the company, with less than 5% belonging to, the landowners with whom we may have done collaboration shares. And it is paid for. So see, there is no, sort of hidden or, liability which is there. So there is net debt, which is 890 crores. There is nothing particularly due on the land side. So the land ownership belongs to us, so as this converts into sales and collections, it's all going to trickle down to cash for the company. And hence we feel very comfortable, not just bringing down net debt, but even the gross debt number, significantly over the coming 2 to 3 years.
All right. Nuama says that you'll be net debt free by FY27. So wonder whether that's doable or not. But, on the launch pipeline itself, you said that it is sustainable. You have this timeline. Could you give us a sense on a quarterly basis, what exactly does this mean in terms of GDV being launched in this year? And what do you have in the pipeline for the next one?
So see, for the year, we've taken a target of about 17,000 crores of launches. In the first quarter, we've launched about 1.7 million, which is close to 3,500 odd crores. Again, reiterating that, let's say the launch we've done, the land is fully owned by us. And hence, it's not just a sale, which is getting created. It's going to create cash, net cash for the company. Likewise, in the coming quarter, there is almost close to, you could say, between 3.5 and 4 million square foot getting launched. So again, quarter 2 is a big quarter in terms of launches. And, likewise, Q3 and Q4 also will see, more launches. So this balance, 13 to 14,000 crores of launches, we are comfortable because we are at very advanced stages of approvals across these projects. And hence, we don't see any possible slippage in terms of the launch pipeline.
Okay. All right. By the way, guys, 10 days back, the PM Awas Yojana, which was meant to boost affordable housing, completed 10 years. This is 25th of June. And of course, the contrast can't be starker.
Yes.
Luxury has done phenomenally well. Affordable, nothing at all. Actually, lenders have told us that there is not enough supply to fund on the affordable side. And I think Signature has told us that earlier as well. Thank you very much for joining us as always. Appreciate you coming on and thanks indeed. We'll take a quick commercial break here. We're going to come back with Biswajit Dhar of Center for WTO Studies and Anup Vadhavan, a former Commerce Secretary. We're going to talk about the Trump tariff letters, the possibility of India-US trade deal. We're at the deadline, so will we hear something tonight? That's the big expectation. Stay tuned. Come back. The market, of course, is doing what it is doing, which is not very much, about 1/3% lower on the Nifty Bank for now. But this is a CNBC-TV18 exclusive. GAIL pipeline tariffs may see an increase of near 20%. Sudarshan is here with details on this. So take it away.
So what we understand through sources that GAIL pipeline tariff, which is expected to come in a month or two, and that tariff revision for its pipeline, there are 10 pipelines for which tariff can be revised higher by 20%. So currently tariff for GAIL pipeline stands at rupees 58.59 per MMBTU, and that can be increased to rupees 70 per MMBTU or higher than that. So if you calculate from 58.59, that increase comes to around 20%. Now, why this is positive for GAIL? Because most of the brokerages in their estimates have factored in the range of 10 to 15%. For an example, Investec is saying it's hoping for a 20% increase, but conservatively, it has modeled a 10% hike in FY26. Jeffrey says it expects 10% increase in GAIL tariff, and if there is a 10% increase in GAIL's tariff, fair value for GAIL as per Jeffries comes around rupees 235, and if there is an increase by 20% in its tariff, then fair value comes around rupees 250. And GAIL management had earlier spoken to CNBC-TV18. It had said that it had submitted for increase to around rupees 78. But if PNGRB, that is the oil and gas regulator, approves an increase of up to rupees 70 or to 71, that will be taken positively. Yesterday, PNGRB member A.K. Tiwari had spoken to CNBC-TV18. Let's listen to what exactly he had to say on the tariff.
I'd like to say one thing, that system use gas is one of the important component, important OPEX for them, for which we have already brought the regulation here. How to reduce the cost of system use gas, wherein we have given that they have to plan 75% of their estimated quantity which they are going to consume. They have to plan domestically or international market long-term basis for 3 years. They have to allocate whatever the least cost is there in their kitty for the system use gas, so that the cost will be reduced. So all these factors are being analyzed, and we are going to take view on that, and we are going to conclude the tariff order very soon.
Okay, well, that's, the gas story. GAIL, positive for GAIL, because as Sud pointed out, expectations were 10-15%. We're talking about 20%, nearly 20%. Stocks, for now, right there, at down about 2% or so. Let's talk about tariffs now. And the big question is, with the deadline here, will actually we see that mini deal between India and the US, perhaps tonight. Biswajit Dhar, professor and head of the Center for WTO Studies, is with us, and so is Anup Vadhavan, former Commerce Secretary, who's with us. Gentlemen, great to have both of you here. Thank you very much for joining us. Mr. Vadhavan, chitti milegi ki deal milegi is the question, if I can put it in. But what's your sense, sir? Where are we at?
That's a million dollar question.
Yeah.
So certainly, it seems from the reports one has been seeing in the press that some agreement has been worked out at the official level. It's lying on the president's table, so to say. And the reactions which have come since then seem positive. There is continued talk from the US president that a deal with India is forthcoming. So that's a good sign. And maybe there is some adjustment in that agreement that would be required, which might be worked out at the official level. So my sort of sense from whatever information is in the public domain is that things look positive, and broadly around the agreement that has been worked out at the official level, some, final initial agreement, it's called an early harvest, will be worked out. So I'm quite, positive based on what one has seen. Although, there's certain concerns, even where the US has entered into agreements, whether it's UK or China, now Vietnam, those are, not very balanced. And the US interests, of course, have been taken care of, but it is debatable whether UK got what it wanted out of it, or Vietnam has got what it wanted out of it. So I think it will be important to see the content of the deal. But what I understand is that Indian sensitivities on agriculture, dairy have been addressed, but then our ambitions should have been adequately addressed also. We have certain ambitions in labor-intensive products and things like that.
And we'll see.
At the end of the deal, we'll still be facing duties on steel and aluminium, which are across the board and now amounting to 50%. Of course, I think for the UK, they have been taken off. It will be interesting to see as to what India gets out of it. Our labor-intensive interests and
we'll certainly, absolutely. And the other question is, what does this deal, in a way, not just with what we will see, but I mean other deals, as you pointed out as well, right? That the China deal, for example, there was that handshake over that weekend, but then after that, nothing, silence. Same thing with Vietnam. I mean, trade deals are not two-page documents, right? Which you announce and then that's it. So we'll have to see. But yesterday, for example, Japan, for example, got a letter. Their tariffs were bumped up from 24% to 25%. And I think both the US and Japanese representatives are on record to say that they're going to be intensifying their talks into that 1st of August deadline. So that is the other thing. Even if you get, are given an offer, this is still time for negotiations in that sense. Mr. Dhar, your first thoughts, sir? What is likely?
No, I also think that, there could be some kind of early harvest. And, there are a lot of low-hanging fruits that can be plucked at this point. I would say that, as long as India's sensitivities and Mr. Vadhavan was mentioning about some of these sensitivities, these are taken care of, then I think it will be possible for us to move forward. But then there is, yesterday's announcements that President Trump is going to impose 200% tariffs on pharmaceuticals. Now that's a problem area because, our pharma industry has a large footprint in the US market. The generic industry has a large footprint and that could get affected. So I think, this copper and aluminum, copper and pharma tariffs, which have been, sort of the speculations are that they are going to be imposed. These would be a kind of, a kind of a dampener. But I still think that there can be some possibility of an early harvest, some low-hanging fruits. As long as agriculture, dairy can be left out of the deal, it's possible to, sort of do something right away.
Yeah, absolutely. But the thing is that, that pharma tariff that he's speaking of, 200%, it's a year down the line, and let's see, too much changes here within 24 hours. So 365 days is a very long period. Let's see what actually eventually comes out of it. But gentlemen, I just wanted to get your thoughts on, what we could be realistically looking at in terms of this mini deal or this interim deal, if it were to come through. So Mr. Vadhavan, what could be India's best case? That the prevailing 10% tariffs continue? And that would not have seemed so bad if it was not for this new BRICS threat. Now he's saying 10% additional tariff on BRICS. So that could mean, speaking today, so we are on 10% tariff, so 10 plus 10, 20 straight away. What India was originally handed out on 2nd April was 26%. So what would be your best guesstimate in terms of what could be a realistic interim, near-term mini deal, so to speak?
Yeah, so it seems that 10% is going to be the new default kind of MFN tariff which everyone will face. So I suppose if that becomes the case, then India will face 10% on most items, and things which are included in the deal. Hopefully, they'll be at a lower rate. So it's all very confusing. And, as was just mentioned, these letters also which are coming, they're open for negotiation because they are not going into effect immediately. There's a 1 month, kind of deadline, 1st August. So scope for negotiation remains. And the other thing we need to see is that the US cannot, sustain as an economy such high tariff barriers. It will elevate costs in the US economy, it will undermine US industry, it will undermine the competitiveness of US businesses. So the end game cannot be that there is 10% duty on every product at a default level. So I'm a bit confused as to where this is going. It is certainly this 25% and 40% which is being imposed certainly is not the end game. because there is a notice period and it's open for negotiation, and it will be, even the other day when there was some of these duties were announced, the stock market didn't take it well. So the end game is not going to be 10% across the board. So in a, I think, somewhat confused manner and somewhat random, ununderstandable ad hoc manner, it will go ultimately to a outcome where duty levels have to be sustainable and reasonable for the US economy to function efficiently and competitively. So let's see. It's open for conjecture as to this mini deal. Are we going to get zero tariffs on the labor-intensive products? As is the normal practice in a trade deal. Trade deal is always 0 for 0. It is not 20 for 0, that you impose 20 and I give you 0. So let's see what it throws up. But the way it is going at this interim stage, I won't be surprised if there are some elements like that in our initial agreement also. But then it's all conjecture. One can't make a very reasonable guess as to what it is going to be like. But ultimately, it is in India's interest that we do get 0 for 0 on all the items which are included in the deal. And of course, some areas are sensitive to the extent India allows little bit of access on agriculture, then that has to be with protections. It can't be zero duty. There has to be some tariff rate quota. So safeguards like that. So I won't really conjecture, but all these possibilities, seem open. Let's see what happens, when it's announced.
I hope both of you will join us, later today if we do hear something in terms of the actual stuff, and then we won't have to do so much in terms of conjecture, but we'll have the details then, hopefully. Thank you very much, Mr. Vadavan, Mr. Dhar, for joining us. Great conversation as always, and some perspective for our viewers. We take a break. Manisha is with us on the other side. Commodities in focus. Okay, welcome back. The market's not really doing very much, and you've got 4-point change. That's it, 25,530. Let's shift focus to what's happening on the commodities side. And there were some moves. Oil's at 70. There was that big move as far as copper is concerned. Manisha standing by with what is top of her mind. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, I'm absolutely looking at copper because overnight markets, that was one thing that was buzzing, and how. The U.S. copper futures settled nearly 10% on the higher side in the overnight markets. But there was at one point when that cabinet meeting was still on and the U.S. president was still talking, that you saw the copper prices run up by almost 17% to hit an all-time high at around $5.9 per pound. This comes in after the U.S. president has said that he's proposing 50% on copper. This is being aligned with existing 50% on steel and aluminum as well at this point in time. Well, the U.S. had launched probe on copper imports in the month of February, and the reports do suggest that the final decision on this is expected by the month of November. But whether or not an announcement can be done before is something that the street really seems to be guesstimating at this point in time. Apart from that, it also has to do with the U.S. importing nearly 50% of its copper requirements. Much of that comes in from Canada, from Mexico, and major part of that comes in from Chile as well. And there are supply concerns for many of these countries at this point in time. If you look at the import numbers, well, higher imports are expected in U.S. ahead of the tariff implementation. As of now, this is an announcement of a proposal. The implementation date is yet to be decided, but before that, you will see a lot of copper being imported into U.S. The U.S. to LME premium currently stands at a record $250 a ton. So that's a very high number onto that side there. Also, when you look at the overall markets, well, we have seen those gain up as well. And that arbitrage or disparity is quite clear to see. The U.S. copper prices in the first half of this year gained up by 26%, while the LME copper prices gained up by 12%. So we are looking at U.S. copper prices trading at a strong premium than what the copper seems to be doing in other two exchanges globally, that is in London and in Shanghai as well. Apart from these as well, there is various supportive factors. A very, very bullish report coming in from Goldman Sachs says that China in 2025 will see copper demand rise up by 6%. A PwC report says that 32% of global semiconductors production could face issues by 2035 with the kind of supply concerns and disruptions that we are seeing in case of copper. Also, there have been reports of roadblocks by informal miners in Peru due to the transportation there. There also is disruption at Panama mines, Congo. Chile drought concerns also have led to lower mining and lower grade mining there in sense of copper. That has been supportive. And when you look at the LME stocks as well in sense of copper, they have continued to decline in this year, down by 64% from mid-Feb. So at this point in time, it is a very, very bullish copper prices continuing into the Indian Asian markets right now. Much would depend upon on what is the follow-up announcement, proposal on sense of tariffs in copper, and that could take the prices higher.
All right. Thank you very much, Manisha, for that. Well, copper is the story, the big story, really, in that sense. We'll take a quick commercial break here. On the other side, it's our special segment. It's the economy. Latha in conversation with Suresh Ganpati of Macquarie Capital on what to expect from a bank and NBFC results in the first quarter. Stay tuned.